Hello. Today we're going to learn about the demand and supply, which are the basics of economics. So first we'll look at demand. The law of demand is that when the price of a product increases, the quantity demanded decreases and vice versa. So when the price of a product increases, the quantity demanded will decrease, and when the price of a product decreases, the quantity demanded will increase. So when you look at the law of demand, you have to be sure that these two go the opposite way. This is how demand curve looks like. So what are the reasons for the law of demand? We have the income effect, the substitution effect, and diminishing marginal utility. Simply speaking, the income effect is that when prices fall, consumers will afford to buy more of a particular good or service, but when prices rise, they won't be able to do so. So the quantity people will buy of a product will decrease. The substitution effect is that when two goods are substitutes, such as apples and oranges, an increase in the price of apples will lead consumers to purchase more oranges and fewer apples because apples are more expensive than oranges. And third, we have diminishing marginal utility. What is diminishing marginal utility? As more units of the same product are consumed more, the satisfaction or utility from each good decreases with each additional unit. As utility decreases, so does the price you are willing to pay. Thus, the decrease in price as quantity demanded increases, as shown on the demand curve. But before we go on, we have to know what the change in quantity demanded versus the change in demand. So we looked at demand, but what is quantity demanded? Quantity demanded is defined as market for a product only has a price change and there is not a shift in the demand curve, but the movement along existing curve. So if you have a demand curve, the quantity demanded means a point moving from another point. However, if you look at change in demand, then you are talking about the curve itself shifting. Like this. So if you see here, we have P1 and P2 and Q1 and Q2. So if a point moves from P1, Q1 to P2, Q2, that is called a quantity demanded moving. Then what makes the demand curve shift? We have SPICE, which stands for substitute goods, preferences in population, income, complementary goods, and expectations. So if you want to memorize these, memorize it as SPICE with two P's. If a demand curve shifts to the right, it means an increase in demand. And with the demand curve shift to the left, it means a decrease in demand. Then what are preferences? Preferences are consumers' tastes or preferences for a good or service. If this increases, then the demand curve will shift to the right because consumers want more of these. Then what are substitute goods? As I said before, increase in the price of one good results in an increase in demand for the other good because this good becomes more expensive, so you won't want it anymore and you won't want a substitute for it, and vice versa. So if you see here, we have market for apples and market for oranges. And you should look at market for apples first. If you look at the graph, the movement along the price is P1 to P2, and the price is getting more expensive. And if you look at for market for oranges, which is in substitute, the demand increases, which means that when one good price increases, the substitute's demand increases by itself. Next, we have population. A population is a number of consumers in a market, and it refers to the total number of buyers in a specific market. So if you have a bigger market, then you have more people, which means more demand. So now we're going to look at income. These two goods are divided by income. So we have normal goods and inferior goods, and we're going to say the normal good is a sports car, and the inferior good is a little sedan. So if normal goods, when income increases, the demand for this product increases. So if you have more money, then you will want to buy a better car and you buy a sports car. However, in inferior goods, when income increases, the demand for this product decreases. Think about this. You gain more money. You earn $10,000 in a month, but now you earn $100,000 in a month. Then you would not want this little sedan, you would want a fancy sports car. This is what happens with income. And now we have complementary goods. And these are goods that are purchased separately but are used together. So you could say complementary goods would be a phone and earphones, because phones go with earphones, but they are separate goods. And expectations are an expectation of higher prices in the future. Then there will be an increase in current demand because people will want to buy more of this good before the price increases, and then they have to pay more money for it. And now we have law of supply. So supply is the quantity of a product a producer is willing and able to offer for sale at a various price. And we have law of supply. And law of supply is that when the price of a product increases, the quantity supply increases, or vice versa. So when the price of a product decreases, the quantity supplied will decrease too. So we have law of demand and law of supply. And in law of supply, the two aspects here go together. One increases, then the other increases. But when the other decreases, then the other will decrease too. This is supply curve. It's what it looks like. So if you want to remember supply curve and demand curve separately, you could say demand down and supply to the sky, because the supply curve goes up and the demand curve goes down. Then what is the change in quantity supplied and change in supply? So if you look here, quantity supplied means the market for a product only has a price change. There is no shift in the supply curve, but a move along the existing curve like we did before with the change in quantity demanded. So if you look here, this is the supply curve, it's applied to the sky, it points upward. And we have Q1, P1, and Q2, P2. So if you look at the movement here, there is no shifting in the graphs, but there's only a point movement. And we have determinants of supply too. But what we have to remember here is the supply and demand are a bit opposite. So if supply goes to the right, then it increases. And if supply goes to the left, it will decrease. And these are the determinants of supply, and we have 6 of them. And you can remember them as cotton. So cost of inputs, other goods prices, technology, taxes and subsidies, expectations like we saw before, and number of sellers, cotton. So let's look at these. What is cost of inputs? It's the change in the cost of producing a product that affects the supply of a good or service. And other goods prices refer to profit maximizing firms will choose to produce what gives them the most profit. And the prices of these alternative products affect their supply of both. And new technology can decrease production costs and increase productivity that results in the supply curve shifting to the right, which means an increase in supply. And taxes and subsidies. A tax on a product of a good will result in increased production costs, which will decrease supply, because you have a production cost and you have tax on it. And when a firm gets a subsidy, a payment from the government to produce a product, profits increase at each price level that induce increased supply. Next up, we have expectations. If sellers think the price will increase in the future, they may hold back the amount offered for sale, decreasing current supply with the ultimate goal of just increasing profits in the future. The converse holds true. If producers think the price of goods may fall, then they will sell it now for the future. And next we have number of sellers. As more sellers in competition enter a market, the supply will keep increasing, which means it's more people, more supply. Next up, we have market equilibrium. Now we're going to look at supply and demand as one, and we have surplus and shortage. So a surplus exists when the quantity supplied is greater than the quantity demanded, which is when price is above the equilibrium price. And shortage happens when the price is below the equilibrium price. So what is an equilibrium? It means that simply the quantity demanded equals the quantity supplied, and you're going to have to find the equilibrium lots of times further on. But then what's disequilibrium? It's the opposite of equilibrium, when quantity demanded does not match the quantity supplied. Next up, we have the double shift rule, which is very important in this chapter. So the double shift rule says when there are simultaneous shifts in both demand and supply, either price or quantity will be indeterminate. And we have a table here and a graph. So this is the double shift rule. If you look here closely, we have D1 and D2 and S1 and S2. and D1 moves to D2, which is an increase in demand, and S1 moves to S2, which is a decrease in supply. And we have this table here, and this is very important. You have to remember this. So we have change in demand, change in supply, then the effect on equilibrium price and quantity. So if demand and supply both increase, then the equilibrium quantity will increase, but the equilibrium price will remain indeterminate. If both decrease, then the equilibrium quantity will also decrease, while the price will be indeterminate. But what if the demand increases and supply decreases? Then the quantity will be indeterminate, and the equilibrium price will increase. Vice versa. Quantity will still remain indeterminate and equilibrium price will decrease. So one tip for remembering this is that you should remember as IIXI, DDXD, IDIX, DIDX. So X stands for indeterminate, and D for decrease, I for increase. And whenever you see a question that asks you to do this, remember the table in IIXI, DDXD, IDIX, DIDX. Next up, we have the double shift rule, which is very important in this chapter. So the double shift rule says when there are simultaneous shifts in both demand and supply, either price or quantity will be indeterminate. And we have a table here and a graph. So this is double shift rule. If you look here closely, we have D1 and D2 and S1 and S2. And D1 moves to D2, which is an increase in demand, and S1 moves to S2, which is a decrease in supply. And we have this table here, and this is very important. You have to remember this. So we have change in demand, change in supply, then the effect on equilibrium price and quantity. So if demand and supply both increase, then the equilibrium quantity will increase, but the equilibrium price will remain indeterminate. If both decrease, then the equilibrium quantity will also decrease, while the price will be indeterminate. But what if the demand increases and supply decreases? Then the quantity will be indeterminate, and the equilibrium price will increase. Vice versa. Quantity will still remain indeterminate and equilibrium price will decrease. So one tip for remembering this is that you should remember as IIXI, DDXD, IDIX, DIDX. So X stands for indeterminate, and D for decrease, I for increase. And whenever you see a question that asks you to do this, remember the table in IIXI, DDXD, IDIX, DIDX. And it will help you a lot in solving these questions. And now we have price ceilings and price floors. So what are these? So price ceiling prohibits prices to rise above a certain level, as in rent, or as the establishment of ceiling, or interest rates for mortgage loans. And price floors are the opposite of these. And one example of them could be a minimum wage. And also, there are additional terms that are called binding price ceiling and binding price floors, which means the price ceiling or price floor is effective, but if it's not binding, then it doesn't have much effect. So first off, this is what a price ceiling looks like. So if you see here, it's supposed to be a ceiling, but it's below the equilibrium price. You have to remember this. And because it's below the equilibrium price, you get a shortage. Here, but this time we have a price floor. And because the price ceiling was below the equilibrium price, now we have a price floor that's above the equilibrium price. And as I said before, because it's above the equilibrium price, we have a surplus. So today we learned about the demand and supply, and we used it to look at price ceilings, price floors, or shifts in the curve. Thank you for listening, and we'll see you next time.